Hi, everyone. Thanks for joining. We're just going to wait a couple minutes here to let people come in, but you've joined the Gilded and ZenLedger webinar about cryptocurrency, taxes, Crypto 101, mining, staking, taxable events, and all that stuff. So feel free to ask questions. There's a Q&A function here, so you can just pop in there and ask questions, and we'll make sure to address them as we go, or we'll address them at the end as well. Feel free to say hi in there. Let us know where you're from. Feel free to shill your favorite token right now. Or if you want to make NFL predictions, jump in as well. Cool. Chat is up. People are jumping in. We can send out the slides. We can also send out the Q&A and a transcript afterward. I'm in Seattle right now. It is, of course, well, actually, it's a little sunny. Joe, where are you at?
Yeah, hey everybody. I am in New Orleans, Louisiana, and it is a nice 60 degrees and sunny day here.
Cool. We're just gonna let people kind of file in for a little bit for the next couple minutes, but feel free to ask questions in the Q&A, jump in the chat, say hi. We'll be covering Crypto 101, taxes, staking, mining, whatever questions you might have. Again, this is from Gilded and ZenLedger. Okay, we have some Packers fans in here.
Pat, are you a Seahawks guy?
So I root for the home team because the town feels good when they're winning. So it was a little sad to see them lose, but it wasn't unexpected. I grew up in Southern California, and when I started watching football in the late '80s, I became a Niners fan because it was Joe Montana, Steve Young, Roger Craig, Ronnie Lott, Jerry Rice, John Taylor,
Oh yeah.
And then they got bad the Garcia days, and then they got good for a little bit again, and then now we don't know how they are.
Yeah, exactly. Yeah, that after I guess last year, trying to rebound from that Super Bowl loss, tough year this year, but we'll see.
Yeah, there were injuries all over the place, but that's football during a pandemic. Who knew?
Right, exactly.
Cool. So I think we're probably good to start. This feels like about the number of people we have. So hi everyone. Feel free to ask questions in the chat or in the Q&A. We have some previously submitted questions too. We'll answer those throughout the talk, and then we'll have a Q&A portion at the end as well. I'm going to go ahead and share my screen. Okay. So hi everyone, welcome to Crypto Taxes and Crypto 101, and we'll also be talking about just crypto issues for consumers and business from ZenLedger and Gilded. Before we begin, the webinar will be recorded. We will share the recording, we'll share slides, we'll probably get a transcript of this and send that out as well as a document with your Q&A questions answered. Quick disclaimer, I'm not a tax professional or an accounting professional, and I'm not your tax professional or legal professional. So everything here is just for information purposes. Everyone kind of is free to make their own judgments and decisions. You should engage professional counsel if you have serious questions, but we're here to help and answer whatever questions we have, but it's not professional advice. I'm Pat Larsen, co-founder of ZenLedger.io. We're here in Seattle. We're a 3-year-old company, VC-backed, 20 people. We've helped many thousands of individual tax filers and tax professionals with their cryptocurrency investments, portfolio management, accounting, and tax compliance. Joe?
Yeah, hey everyone. I am Joey Ryan. I am the CFO and co-founder here at Gilded. We are a 2-year-old company. We are helping businesses be able to transact utilizing digital currencies. So we're creating that kind of back office system for businesses to onboard onto kind of the blockchain and utilize digital currency for all their transactions. So kind of going hand in hand with tax, we're performing kind of the digital currency accounting piece.
Cool. Okay, so here's what we'll be covering today: Crypto 101, IRS 1040 tax form and the tax warning letters, DeFi and ETH staking, business utilizing digital currencies, tax strategies, some coupons and giveaways at the end, and then Q&A. So congrats for being on the roller coaster ride that is crypto. I think we're back up at 40,000 on Bitcoin.
Yeah, we all survived the 4-day bottom, right? Bear market. It was a toughie, let me tell you.
Yeah, it was just long enough for you to really start panicking. It came back. So everyone here is probably pretty sophisticated. That's why you've realized that there are tax issues, and you're probably into mining and staking and thinking about some more advanced topics. But just realize that the volatility will continue, and the decisions you make on how you manage your portfolios and how you manage your accounting and the cash flows in and out of your business will be affected by that price volatility, because we're living in a world where we're deeply engaged in virtual currencies and digital assets, but we pay for food and rent and stuff in some fiat currency. And so there's just a lot of volatility all around that you need to think about as we go. So the IRS has kind of first put out guidance in 2014 about digital assets and cryptocurrency. And since then, there have been a couple updates. There's been one small law passed by Congress, but otherwise, crypto in the US still remains in kind of this gray area where there hasn't been really coherent legislation passed that lays out regulation and taxation of cryptocurrency and digital assets. You just kind of get a one-off here and there, like Bitcoin's not a security, you can't 1031 exchange crypto, and stuff like that. So that's kind of the area we operate in, and your tax professional or legal counsel should kind of realize that as well as they go. So you kind of have conservative or aggressive takes on all these things. What is taxable event is something that still needs to be addressed from time to time. And so selling crypto to fiat is taxable. Buying crypto with fiat is not taxable. You've probably earned that fiat in one way or another, already paid taxes on it. And so buying Bitcoin with dollars, buying Ethereum with yen or whatever is non-taxable. A stable coin is not fiat. So if you buy USDC with dollars and then buy with Bitcoin, that's two taxable events. There should be really no gains or losses when you spend your US dollars and buy your US based stablecoin. It should be 1-to-1, but sometimes it's 99 cents or $1.01, right? So there's these little fluctuations even with stablecoins. But when you sell Bitcoin out to stablecoin, that's taxable event. And then when you sell your stable coin for US dollars, that's also a taxable event. But again, you shouldn't have much profit and loss when you're going from a stable coin to the fiat currency that the stable coin is denominated in, but you'll see fluctuations, right? So it's just something to keep in mind. ICOs and DeFi and mining and staking, they all create income or taxable events that you have to keep track of. There's holding periods and cost basis that generally you need software to take care of. That's why we built ZenLedger. Let's see here. Yeah, so receiving crypto for goods and services rendered is just like ordinary income. If you do some consulting work and you say, hey, send me Bitcoin instead at this hourly rate, then that's income to you, and you have to convert it to dollars at time of receipt and pay income tax as if you had been paid in dollars, just like if someone compensated you with a used car or some stock or something. And then receiving crypto from fork, mining, airdrop also is income. So you have ETH, it splits into ETH and ETH Classic. Now you have two assets, and you have a new cost basis for the asset going forward. When you get airdropped Bitcoin Cash, that was a big one. You had a liquid market, you could have sold it when you received it. And so you count as income at that time. There are caveats for if you have possession of that asset, if you have control of it. So like ETH2 or Coinbase, like waited 2 months to release, Bitcoin SV or something to me. Those are some gray areas that you and your accountant can work out. You can make some decisions on that stuff. But some other things to consider there. What is non-taxable event? Purchasing crypto with fiat. As we mentioned, you can buy all the crypto you want with dollars. You've probably already been taxed on those dollars. So that's not a taxable event. Donating crypto is to a tax exempt organization is fine. You give them your cost basis, which is favorable to them. And it's a great way if you want to support a cause and you've profited a lot from cryptocurrency, then great. Gifting cryptocurrency, there's a $15,000 limit, but you can gift cryptocurrency just like you can gift other financial assets, non-taxable to the recipient. And transferring crypto, so self-transfers are non-taxable. So you move from Coinbase to your Ledger wallet to Binance. Those moves are non-taxable. Your cost basis moves across. And actually, since there's exchange fees or transfer fees each way, those add to your cost basis and reduce your tax liability a little bit. So again, if you're making all these trades and movements, you kind of want software to keep that clean. Joey, do you have anything to add there?
No, this slide I don't. I mean, it's pretty straightforward, as Pat was saying. And just think of for those of you that if you're confused as to why like transfers are not taxed, just think of it as like a bank account, right? If you have multiple bank accounts and you move money between your bank accounts, it's same thing, right? You're not sending it out. You're not using it to purchase goods or anything like that. It's just moved internally between your own possessions, so not taxed there. But otherwise, everything else should be pretty straightforward.
Things are taxed when they change ownership or when the asset kind of changes its nature. So that's when you incur taxes.
Yeah, and actually one more quick thing to add to that is the easy way that I at least people that are first getting into crypto that try to understand the tax piece, I say relate a lot of it to basically the same as like security or investment portfolio trading. So like if I was to buy a cup of coffee with Apple stock, if you're familiar with taxes for basically like stock, when you're trading in and out or buying and purchasing, selling, etc., it's similar, right? So people that are new, I say just relate for tax purposes, pretend like you're doing these activities using Apple stock or whatever stock it is. And that will help you kind of brain facilitate, understand like how this is working.
Yeah, cool. Okay, some other quick crypto 101 things. There's different accounting methods that you can use. First in, first out, last in, first out, highest in, first out. IRS guidance has generally said that first in, first out is the most defensible and conservative and the one they recommend. If you or your tax professional want to get more aggressive, and because of the trading patterns and when you acquired these assets, last in, first out, or individual lot, specific ID are more beneficial to you, you can go ahead and do that, but just realize that it's not the most conservative approach, which is fine. We have a lot of high net worth clients that are extremely aggressive in their taxes, but they do it in conjunction with their legal team and their accounting team, and they realize that keeping a couple $1 million in crypto for an extra year is very beneficial for them. So they're willing to take some of that risk when they go to their accounting. Forks. So hard fork is when a new token like Bitcoin Cash is treated as ordinary income at fair market value at the time you received it in your wallet. So on day 0, you just have 1 Bitcoin. On day +1, you have 1 Bitcoin and 1 Bitcoin Cash, or I can't remember if it was a 1-for-1, but that, so that let's see here, that $3,000 of Bitcoin Cash that was airdropped is now income for you. And then the clock starts on your holding period. So if you hold that Bitcoin Cash for less than a year and you sell it, you may have capital gains attached to it. Say it was airdropped at $3,000 to you, you sell it a month later for $3,100. You have a $100 capital gain and it's a short-term capital gain for that Bitcoin Cash that was airdropped to you. Say again that you held it for a year and a day, so 366 days, and then you sold your Bitcoin Cash that was airdropped to you for $3,000 for $3,200. Now you have a $200 long-term capital gain, which in the United States, long-term capital gains are generally taxed at a lower tax rate than short-term capital gains, but they're also dependent on your income tax bracket. So it's kind of a moving target that you have to think about. And then there are some exemption levels. And then, so just think about those things as you go. Soft forks, there's no new token. And so there's no new consequences. It's just like a company being under new management, but nothing else changed. So there's no taxable event there. Airdrops, just kind of mention again, it's just like the hard fork. When a token comes into your possession that you didn't own before and you didn't pay anything for it, it's treated like income. That's basically how you can think about it. Mining, there's professional miners and there's hobbyist miners, just like there's professional traders and hobbyist traders. But with mining, you can claim it as other income. You can deduct some expenses like buying the rig, your electricity, your air conditioning, all that associated stuff. And you can itemize and deduct it. Or if you're running it as a business, you should have incorporated and you should be running the income and expenses through your P&L. And Joey can talk more about that in another slide, I'm guessing, right?
Yep. Yeah, and on this slide, one thing I want to touch on too is in order to basically minimize your tax liability the most, basically that HIFO method is going to work the best for you, and that stands for highest in, first out. So that's sending basically the cost basis of your crypto that you're selling is going to be the highest cost that you have of tax lots kind of sitting in your possession. So that's making sure that any gains that you have are kind of minimized, or any losses that you have are going to be maximized. Now, as Pat was saying, it's super important that if you're going to use HIFO, which is a form of specific identification, the IRS has laid out some specific guidance as to exactly what you need to kind of show or keep for your, if you want to say, audit support, in case you were to get audited. There is some guidance that you can find on the IRS FAQs. I'm not going to read the whole thing, but basically it's just saying in a nutshell that keep your documented audit trail of the exact tax lots that you're identifying for what you're selling for each transaction when using specific ID, so that you can basically support your position of hey, my cost basis is this, and that's something that ZenLedger definitely helps with.
Yeah, and mostly the vast majority of people do all their trading on exchanges, and you'll have an API or CSV export from the exchange, and you'll be able to support your cost basis at time of acquisition, time of disposal. The only time it gets a little weird is if you're mining or you're doing OTC stuff and you have to bring in like blockchain records, but we can help you document that as well. You'll have a transaction ID, a hash, and create a little spreadsheet, and you can cover yourself that way as well. IRS 1040 and warning letters. So a couple of the bigger developments that have happened is over the last 18 months or so, the IRS has started sending out more warning letters. This is stemming from the 2017 lawsuit where the IRS sued Coinbase for client records, and the IRS won. And Coinbase and a couple other US-based exchanges have been turning over records for people with over $20,000 of aggregate trading activity, which just means like a half a Bitcoin that you buy kind of trips that now. These warning letters are basically saying, hey, we see that you have cryptocurrency trading activity, and this is a reminder that you need to pay taxes on crypto. Some of them get a little more serious in their warnings. Some just kind of say you don't have to reply to this, but some of the more stringent warning letters are saying, hey, we're basically opening up an investigation on you, and you need to respond to this, and we're going to proceed with the investigation whether you respond or not. And 2021 is the first tax year where on the 1040 form, the form that everyone fills out, above the fold, you have to check a box answering yes or no. Did you transact in digital assets in the last year? So that is, buying or selling, receiving, mining, all that stuff. So you or your tax professional are going to answer yes or no on the 1040 this year. when you file your taxes. So that is showing that the IRS cares about this. They're watching, and they've made it a priority. The top of the fold of the 1040, that tax form brings in trillions of dollars of tax revenue a year. It's kind of serious. And you can see through other IRS enforcement actions, like going after John McAfee, who I don't know what his net worth is now. It's kind of hard to track, but he renounced his U.S. citizenship, was in Belize, ran around the world marketing cryptocurrencies and ICOs, and ran afoul of the SEC and the IRS. He was arrested in Spain and is, I think, awaiting extradition. So they're probably going to take the guy to court. He's going to lawyer up, and they're going to slug it out. That IRS is willing to go head to head with a tech multimillionaire or billionaire. They're willing to bring cases involving cryptocurrency, as is the SEC, saying that he aided in the selling of unlicensed securities. So they're going to, subpoena the ICO teams. There's going to be a lot of evidence there. It's just kind of showing you that the United States is serious about this, and then other governments around the world are kind of taking different tacks, whether it be Switzerland, that is kind of trying to create an innovation hub for cryptocurrency. Canada set up kind of more of a sandbox where they're not going to mess with things too much, and they're going to let innovation go for a while. And then, which is different from what the United States is doing. So, Joy, do you have anything to add there?
No, I'll jump in on the next slide. You covered it.
Okay. Yeah, I think we're good here. But again, here's the 1040 form. A yes or no question. Whether you, and you'll have to answer yes if you received crypto, sold crypto, trade crypto, or use crypto to buy goods and services. You can answer no if you only held crypto and there's nothing else. But everyone kind of receives airdrops and other things. And then I think if you, and transfers between your wallets is fine. But I think also if you are engaging in DeFi, right? So if you're just getting interest payments in the form of cryptocurrency, then that's going to be reported here in digital assets. If you're getting your interest payments in dollars, then you're not checking yes here, but you are reporting that dollar income on your 1040 anyway. So that's kind of a weird place where you could have a big chunk of cryptocurrency, you haven't moved it around, it's just been at BlockFi for 2 years, and you've been receiving cash USD interest, and you just report that like a 1099 miscellaneous probably.
Yeah, exactly. And as Pat was talking about, it's important to note that obviously it's on the face this year, that question, they moved it from Schedule 1. So anybody that maybe didn't have Schedule 1 income in the past may have missed that question. So that's the reason as to why they put it right there in the 1040. It's right below when you literally put your name and address and first question they're going to ask this year. And even with they did release some new updated draft instructions for the 2020 1040 that clarified the definition of virtual currency. So you can check that out on irs.gov. But even with these new draft instructions, obviously what we're getting at here is crypto tax guidance, and you'll see when we get to DeFi is really still far from being comprehensive. A good example is we still don't know whether a taxpayer who owns Bitcoin through a pass-through entity needs to check yes for this question, because the financial interest portion of the question is still kind of subject to interpretation. So there is some gray area still, even with that yes or no question. But on the safe side, I say always just check yes.
Cool. And I've mentioned the warning letters, but more specifically, they're the letter 6174, 6174A, 6173, and CP 2000. And they kind of get more serious as you go. And if you get these letters, you should probably consult a tax professional, unless you're pretty sure that your regular tax filings will kind of clear it up. A lot of these letters are not super targeted. It's just because Coinbase sent a 1099K report to the IRS, and the IRS says, hey, I see you have $50,000 of aggregate activity, which means you could have just bought and sold a Bitcoin. That's it. At no profit. You could have bought it and a millisecond later sold it and just be a wash. And they would still say, hey, we see all this activity here. You better report. And that's really as simple as that. But there are also more dire warning letters where they think like, hey, in 2018, we see that you have $10 million of trades and you didn't report any cryptocurrency activity in your 1040. We're coming after you, right? And that's a little more concerning.
Yeah, exactly. And just to give a quick little deep dive, or not deep dive, but little definition to each of these letters. So if you get a 6174 or 6174A letter, those are no action letters. You actually don't have to respond if you've met all of your crypto tax filing obligations that are noted in the letter. So if you've met them from the past, you don't have to respond. You may have to file an amended or delinquent tax return though if your crypto taxes were not properly filed in 5 years in your prior years. So definitely consult your tax professional on that. If you get a 6173 letter, that does require action. If you do not respond to this letter on time, you probably will get audited. It's almost 100% guarantee. So make sure that you read through carefully exactly what you need to respond by and when, and what you need to provide to the IRS. And then if you get one of those fun CP 2000 letters, which I've seen that are fun, as Pat was saying, you know, the exchanges are just reporting basically your transaction activity and not reporting the cost basis or the actual gain loss is where those are being triggered. But the CP 2000 letters, you need to respond to those as well. So make sure you read through those letters, identify exactly what the IRS is asking for, and respond within that 30-day window, or else you're subject to fines, penalties, all that fun stuff. But definitely consult your tax professional when you get one of these, and they definitely should be able to help you out. If they can't, find one that can.
Yeah, so that's a great point. One is that we've had clients where they submitted their 2017 tax returns for like the third time because they're trying to get the ICOs correct and everything. And after the third submittal, they got a letter back from the IRS Criminal Investigation Division saying, "Hey, thanks. We're going to close the criminal investigation we had open on you." So they're, you know, like they do recognize when it's good faith efforts and you're trying and they think you've gotten to the right place. They won't tell you if they have like a real criminal investigation open on you, but they'll tell you if they've closed it out because they see that you're a good guy and you're trying. A lot of our customer anecdotes are things like, you know, they've had the same CPA for 30 years, they have an LLC, they have a 401k, an IRA, and the CPA basically like tries to fire them as a client once they start investing in cryptocurrency. But if you just kind of use ZenLedger and prepare your A949s, and we provide a full audit trail, full profit and loss analysis, and a tax loss harvesting analysis for you, those are things that CPAs are comfortable with, and they can just integrate that very easily. That you just have your short-term capital gain or loss, your long-term capital gain or loss, your accounting method, all clearly stated there. And you know, a tax professional is very comfortable putting that next to your you know, your day trading activity, your income, your real estate income, all those types of things. So those are things that more and more tax professionals are going to get smart on cryptocurrency because more and more individual tax filers are investing in cryptocurrency. But we're still at the very early stages where a lot of tax professionals are really weary of this or leery of it, and they kind of still believe the myths of like, oh, cryptocurrency is only used in crimes, it triggers automatic audits, you know, all those types of things. They don't really know what's going on yet. Cool. Well, Joey, take it away.
Yeah, so everyone's favorite, DeFi, which is probably where most of the questions are going to come from, because there's just a lot that's in here, right? So I'm going to try to unpack this in as simple form as I can. So all the guidance that's been issued by the IRS has been obviously generic, and it does not address DeFi at all. So we have to create the bridge between kind of the existing guidance they give us and then kind of applying those rules into the DeFi framework. But there is enough guidance out there right now in place to infer specific tax implications of DeFi and yield farming transactions. So let's dive in. We're doing this based on a transaction basis, right? So this is how you kind of would apply your transaction types going forward. So let's start with lending. So lending, when you're lending, a user locks an asset into a DeFi protocol in exchange for a protocol token that represents their locked position. So compound or urn, right? You're you're receiving a C token or an Aave token or whatever it may be. So example, if Bob locks 1 ETH into a protocol where you purchased the ETH for $100, and at the time of deposit, 1 ETH is worth $300. And Bob receives 50, let's say X ETH tokens representing his contribution to the liquidity pool, and X ETH tokens are tradable at other exchanges and are worth $1 per coin. So is this taxable or is it not taxable? Well, this is where it gets fun. It can be argued really both ways, right? It can be a taxable event. It can be argued that Bob is disposing his original ETH position and receiving a new crypto token called XETH. And then going back to what we talked about earlier, if you're doing that, crypto trades are taxable. So when Bob receives his collateral back at a later date, he does not receive the same exact ETH coin he deposited, right? So it could mean that a disposition of Bob's original ETH, therefore kind of reporting a $200 worth of capital gains. Now you could argue that it's non-taxable by saying, well, Bob in this scenario is not disposing of his ETH. He's really only disposing, or excuse me, he's really only depositing assets as collateral. And his intention is obviously just borrow funds against ETH. His intention is not to sell the protocol token. So again, could be taxable, could be non-taxable. You can take a position as long as in these scenarios that I'm describing, you take a position as long as you have kind of the documented trail and evidence that supports your position. I always say, if you can do that, especially when there's not specific rules around this, you can appropriately do that. Again, I'm not your tax CPA, so make sure you're consulting your tax CPA on this stuff. Wrapping. Certain protocols are going to require you to wrap coins before they can be deposited into a specific blockchain smart contract. So example, BTC, we all know, operates on the Bitcoin blockchain, not on the Ethereum blockchain. So to use it on Bitcoin, you have to wrap your Bitcoin, and that locks your BTC in escrow in exchange for basically an ERC20 token version of your BTC called wrap BTC, right, or WBTC. So again, same thing. We can argue both sides, whether it's taxable or not taxable. On the taxable side, it can be argued that the wrap version of the original coin is now a new coin, resulting in a disposition of the original coin. And again, crypto-to-crypto trades are taxable. On the non-taxable argument, you can say the intention of wrapping a coin is to add additional functionality to the original asset to integrate it into DeFi protocols, and therefore you're not disposing of the asset, and wrapping is not a taxable event. So 2 arguments can be made there. Going down the list here, borrowing. Example, Bob now receives 100 XETH, which is worth $100. XETH is our protocol token. In that event, it's not a taxable event, right? So you're basically, you lock up and you receive your borrowed funds, similar to receiving any sort of loan money that you receive if it's just fiat, right? You take out a loan, a home equity loan, that $200,000, it's not income, it's a loan. Where are we going next? Oh, paying interest. Here we go. When you borrow funds from a DeFi protocol, you have to pay interest to the platform for the risk assumed by the liquidity providers. Interest expense charged on loans is one of the main sources of income for DeFi platforms. So the deductibility of this interest expense really depends on the use case of the loan proceeds. If the borrowed funds are used to buy a car or another personal expense, obviously then the interest expense is going to be considered personal, and obviously not deductible. However, if you use those borrowed funds for investment purposes, so example being yield farming, where you're then taking that interest and basically locking it up again, then the interest expense you incur is classified as investment interest expense, right? And that's kind of a whole separate ballgame as to how the tax rules are applied to investment interest expense. Kind of in a nutshell, they're deductible up to your net investment income. But you can take the position that something like yield farming, it's investment interest expense, and you can get that deductibility. Next, earning interest. So example, Bob now receives, let's say 0.1 ETH as interest for providing liquidity to a liquidity pool. At the time of receipt, 1 ETH is worth $1,000. this is going to be a taxable event, right? Just similar to earning any form of interest income, receiving interest rewards is a taxable event where you record the income at the fair market value of the time that you receive it. Earning governance tokens, next on the list. Example, in addition to earning ETH interest, Bob now also gets one compound token. Again, this is a taxable event as it's taxable income that is reported at the fair market value at the time of receipt, right? So you're receiving income, even whatever type of token it is, it has a value associated with it. It's going to be income. Liquidation of collateral. So now let's say the price of ETH drops and Bob's DeFi platform liquidates his collateral at $75. Now this is going to be a taxable event, just similar to the sale of an asset. Bob would have to pay then a capital gain or loss on his gain or loss position at the time of liquidation. So if you get liquidated, it's the same as selling your asset. And at the price it gets liquidated, you determine whether you have a capital gain or loss associated with it from whatever your cost basis in that asset was. Gas fees, we actually had a question on gas fees. So as Pat was saying before, transaction or gas fees, I guess we'll two types here. So let's talk sales of crypto and then transfers. So if you're selling crypto and you're paying gas fees, fees are deducted from the proceeds. So if Bob, our guy Bob here, sells one ETH for $100 and spends $5 for gas, his sales proceeds are going to be $95. So it gets netted against your total proceeds. And then gas fees on transfers, as Pat was saying, they get added back to the cost basis of the token. So Bob, if he purchases one ETH at $100 and then he transfers it over to MetaMask and has a $2 gas fee, it gets added to his cost basis. So now his new cost basis is going to be $102. So as Pat was saying before, if you're moving funds around or you're moving tokens around from wallet to wallet to wallet, and you have those gas fees, you can just add them to your cost. You add them to your cost basis, and then that actually reduces, if you're selling it for a gain, reduces your taxable gain. And then lastly, everyone's uni drops that we all got this what was that, September, and we were all like woke up with an extra couple $1,000, and we were like, wow, this is pretty awesome. That is of course going to be taxed as income, right? So same as somebody basically giving you $3,000 on the street, they're going to record it as taxable income at the time you gain control. You report the ordinary income based on the fair market value at the time that we all got our uni tokens. That's my quick rundown. Pat, what do you have to add?
We support DeFi. We add protocols as fast as we can, and if we don't specifically say we support a protocol, or we can always figure out a way to create a quick spreadsheet or a couple manual entries. Again, there's just an explosion of things you should do, but you should also consider the tax implications. Someone who makes like 15 different trades in trying to kind of hack DeFi may see that it's not nearly as profitable as they thought it was, and they don't quite realize the risk they're taking with different holding periods and things swapping around, and the gigantic gas fees that people are paying right now. But I think you kind of covered everything. Okay, ETH2 staking.
Yeah, I'll jump into that one too. So hot topic, right, with ETH2 coming out. So the IRS obviously has not issued any staking specific crypto tax guidance. So we're going to, again, have to kind of use the existing framework here to infer tax implications when it comes to staking. So the two scenarios that we have are converting ETH to ETH2 and then earning ETH2 staking rewards. So it's still unclear, right, how the exact transition from ETH to ETH2 is going to look in practice. So it's going to fall into one of these two buckets. Either A, we're going to treat ETH and ETH2 as two separate currencies. Now, if ETH and ETH2 are going to be two separate currencies and you can trade back and forth between those two, taxable event, right? Going back to what we've been saying before, anything crypto to crypto creates a taxable event. Now, if the migration from ETH to ETH2 is just like a one-time upgrade, and this is going to be basically no taxable event. So this is similar to a coin swap where the same property is simply represented by a new token. So in this example, going from ETH to ETH2 will be a one-time upgrade. You get the equivalent number of ETH2 tokens for ETH. And in this example, your cost basis and holding period of ETH transfers over to ETH2. So you'll have that transfer over of cost basis. And that's going to be treated similar to a non-taxable coin swap. So non-taxable in that event. ETH2 staking rewards. So earning ETH staking rewards is a taxable event, similar to earning governance tokens, similar to earning any sort of interest, right? All of that interest income, governance token income, staking reward income is taxable. The question that comes down to on this is the timing of when is it taxable. And it's when you receive each reward into your wallet. And so when you receive a staking, but where it gets confusing is when you receive the staking reward, but you do not have the right to immediately sell, trade, transfer, or withdraw the rewards, meaning this gets into the legal term of dominion and control, which if you guys have any lawyer friends, I'm sure you've heard that 1,000 times, especially in the crypto space, is this concept of dominion and control, because that's when you technically receive the tokens, is when you have dominion and control. If you don't have dominion and control, you don't kind of recognize it as received income until you have that. And then the second you have that staking income, where you gain dominion and control, that's where you basically record the fair value of that income, of that staking reward. This aligns very similarly with how as Pat was saying earlier, how the IRS reports airdrops income, where, quote, this is straight from the IRS, a taxpayer does not have receipt of cryptocurrency when the airdrop is recorded on the distributed ledger if the taxpayer is not able to exercise dominion and control over the cryptocurrency. So when you basically achieve that dominion and control status is when you recognize it as received income at that fair value.
Do you think the uni airdrop qualified as you having dominion and control at the time of the 400 tokens at $4?
My personal is yes. The second I basically got it, I sold it. I didn't hold it, so I'll disclose. I was like, I'll take my profits right away. So the second I got my uni tokens, I sold them like pretty quickly. So I had dominion and control in my MetaMask wallet pretty much that day, within minutes or whatever. I wasn't like sitting there waiting for them because it was a surprise to me. But anyways, I had it. So I would say that if you were sitting there and you had it and it hit your MetaMask wallet, or whatever your Web3 wallet was, and you traded them that day or whatever, that's dominion control, fair value at the time that you received them. And then when you sold them, if you had a gain or loss. I remember that day they pumped a little bit. So if you sold them that day, you probably had a gain, which
they
I know I did.
More than a little bit.
Yeah. Didn't it $9 or $10 at one point?
It went up quite a lot. Yeah, that first day. It dwarfed the stimulus check.
That's right. So yeah, I did get a little bit of a gain from that. So yes, to answer your question, I would say yes, but again, everybody's situation is a little different.
Yeah. Cool. Okay. All right. Sure.
Yeah. So getting into just for our Gilded users out there and those that are businesses, really the world has rapidly kind of shifted to businesses without borders, but our financial infrastructure was not designed for global commerce. The traditional financial infrastructure that's built on traditional payment rails requires banks and middlemen to facilitate transactions. And we know that digital currency really eliminates the middleman and makes payments 1,000 times more efficient. And by eliminating the middleman, the three biggest benefits that you're getting by transacting on the blockchain payment rails are faster, cheaper, and more transparent. So we'll go into an example real quick. Next slide. Okay, so real quick high level example. So this is comparing, and my screen's up here, so I'm just pointing. This is comparing a wire transfer, a credit card, and a digital currency transfer at $10,000. So if you send a wire transfer at $10,000, you're gonna have and we're talking about overseas, right? You're gonna have a $40 bank fee. You're gonna have approximately a $200 FX fee. You don't know when the recipient receives their money. You don't really know what the net is. You're kind of guessing. everybody's dipping in and taking their percentage out. In the end, the receiver within 1 to 5 days, could be even more than that, gets $9,760. Transacting utilizing digital currency, $10,000 payment, you could have as little as a 10-cent blockchain fee, and maybe you have a $50 exchange fee. But in the end run, the end user is getting $9,949. So comparatively speaking, you're looking at a 96% faster payment speed and a 75% lower fee overall, right? So if you're a business that's doing business international and globally, there's no reason not for you to start taking advantage of transacting in digital currency and utilizing digital currency going forward. And the big benefit, go ahead and go to the next slide. Everybody says, well, I don't want to transact in Bitcoin or Ethereum or any of these tokens because they're so volatile. Well, that's where stablecoins comes into play. So the stablecoin market cap has exploded in 2020. Stablecoins like USDT, USDC, DAI, and tokens like that, they're all what the word says. They're stable. They are 1-to-1 to the US dollar. Some stable coins are backed by actual dollars held in bank accounts. Some are backed basically algorithmically, and some are backed by a basket of assets. But a business can utilize digital currency stable coins as part of their kind of back office transactions. So accepting payment, sending bills, sending invoices, accepting stable coins, and then paying bills in stable coins. And by doing that, you're transacting on the blockchain. You're getting those benefits of faster, cheaper, and more transparent payments. But really, what you're getting here too is everybody's like, oh, I don't want to do this because there's tax. With stablecoins, as Pat mentioned earlier, I'm going to say there's basically no tax. Yes, some of these stablecoins fluctuate a penny up, a penny down, maybe 2 cents up, 2 cents down. In the long run, it's going to net to something that's extremely immaterial anyways, right? So you're not paying any capital gains tax. This is how a business can take advantage of blockchain payments. You're not paying any capital gains tax for sending digital currency or receiving digital currency. Obviously, it's the same as receiving dollars. It's income, right? So you got to pay it's taxable as part of your taxable income. But when you're sending these payments, those capital gains that go with Bitcoin and other volatile assets go away. 1-to-1, there is no capital gains. So you're not worrying about any sort of capital gains tax or anything that triggers a taxable event when you're selling because you're utilizing digital currency. So a huge benefits for businesses to onboard and utilize digital currencies going forward. Awesome. And then we're going to this is the last slide, and we'll have about 10 minutes for Q&A. I know you guys have a ton of questions. Yeah, just some strategy basics that I get a lot of questions about, like, what can I do to avoid taxes, all that for crypto, right? So businesses, as I just said, they can take advantage by transacting, utilizing stable coins that are pegged 1-to-1. By doing that, there is no gain or loss. So you can go ahead and buy your Starbucks with USDC. Even individuals, right? You can buy your Starbucks with USDC, no taxable event there. Use stable coins for purchases where you're not trying to trade or invest. If you just, as an individual, use stable coins for that, there's no gain or loss associated with that. Tax loss harvesting. So you all have probably heard of this. What this really means is you can sell a crypto that you're holding, a token that you're holding that's in a loss position, and then basically rebalance your cost basis and repurchase it at a lower price. So the way this works that I explain it to people is, say you're holding Ethereum and you bought in at $1,200. Let's say the price hit $1,200 right before the end of 2020, and now just what it pulled back to like 800 the other day, right? It's 800 now, or yeah, it's 800. Okay, let's start over. So let's say it hits 800 before the end of the year. You bought in at 1,200 in 2020, and before the end of 2020, it hits 800. So you're in a $400 loss position. Now, 12/30, December 31st at 11:59. I'm like, okay, you can sell it. You can recognize you have an unrealized loss by selling it. You recognize that $400 loss. You can buy it back literally a minute later at that almost basically same price that you sold it at. So you're still holding the same fair value, but now you've rebalanced your cost basis. So you have a lower cost basis, you're in at $800, and you've recognized that $400 loss, right? So that's kind of the premise of tax loss harvesting. You don't have to do it at 12:59 on December 31st. You can obviously do it days before if you're not gonna like basically rebuy in the fluctuations, right? The reason that you can do it in crypto, and this is something that you can't do with kind of regular securities, is the IRS has what's called a wash sale rule against regular securities, where basically if you were to try to do this with Apple stock or something like that, you can't, if you rebuy that stock within 30 days, you can't assume that new cost basis. You have to keep your old cost basis that you've had before. So it's a 30-day window of when you sell and when you repurchase to get a new cost basis. But the IRS has not given any clarity or specific rules about that being in crypto. So I tell people all the time, do it. There's nothing that says you can't, and you can definitely take advantage of harvesting your losses and utilizing those losses to net some of your cap gains, net your Uniswap gains, your Uni token gains if you sold them. HIFO cost basis, we talked about that earlier. Utilizing a HIFO approach to your cost basis is going to maximize the total cost of your crypto sold, therefore minimizing as much as possible your cap gains and maximizing your capital losses. A self-directed Roth IRA, I'm actually in the process of finalizing this for myself. Not tax advice. Everything that I have read, if you have a regular self-directed Roth IRA, right, all earnings within a Roth IRA are earned at tax-free when you take them out, right? So your dollars that you're putting in are taxed at the time that you basically have received them through income tax. You put them in, they're taxed when you put them in, but then the earnings and appreciation on those securities and assets are not taxed when you take them out, right? So there's now self-directed Roth IRAs out there, or IRAs even, where you can invest directly into Bitcoin and other cryptocurrencies. So if you put it all into Bitcoin or ETH or other cryptocurrencies, and you're 30 years old and you hodl for 35 years, when you hit 63, 65, I always forget, those earnings that you've earned on your Roth IRA are tax-free. So another way you can take advantage of appreciated gains in Bitcoin and cryptocurrency and not pay tax. And then lastly, time your crypto sales. So again, if you're holding near your end in a game position, don't sell, right? Like say you have gains, and it was last month, December 30th, and you're like, oh man, I want to recognize these gains. Don't sell on December 31st, because then you got to pay the tax on those gains April 15th, 3 months later. Sell on January 1st. That gives you a whole 15 months, right, till next year's tax time, April 2022, to literally pay the cash on those gains that you've recognized, right? So typically you've seen, and anybody that's familiar with crypto trading, you always see a dip come January. I think that's maybe what our dip was a few days ago, was everybody kind of recognizing some of those gains early. But yeah, that's my last piece of kind of tax strategy advice. So let's answer questions before we run out of time.
And ZenLedger will give you a full tax loss harvesting output. We'll granularly say like, hey, of your 10 ETH, 5.5 you can sell at a loss right now. These other 4.5, don't sell them because they're trading at a gain, and we'll tell you it's a shorter long-term capital gain. So can I do that for you? A quick wrap before we head into Q&A. Let's just give everyone our contact information here.
Yes.
You can contact us, gilded.finance, hello@gilded.finance. Or ZenLedger.io and hello@ZenLedger.io. In our app, there's always a chat button in the bottom right. It's like a green and white smiley envelope that you can talk to. And there's a discount code of webinar15, webinar15 to use at Gilded or ZenLedger for the services. Okay, and then we can jump into Q&A here. I think we've covered most of this. We want to be respectful of everyone's time. Is there anything you want to address?
Yeah, sorry, I'm pulling this up. Give me one second.
Mhm.
We've covered most of these. I did have, okay, promotional giveaway. So, okay, well, the first one, if you're considering participating in a promotional giveaway, that you could complete a quiz or open a wallet to earn some crypto coins, how's that treated from a tax standpoint? Doesn't need to be reported, and how is there a dollar threshold? So my answer, all of this is not tax advice. We've been saying it the whole time, but it's not tax advice. It's just an opinion. Opinions, we all know what opinions are like. So any income received which is not gifted to you is supposed to be reported as taxable. That's been the theme of this whole webinar, right? So in this instance, it may qualify as kind of a prize or swag. Then basically at the fair market value at the time that you receive the prize, it's received as taxed into ordinary income. And then when you sell it, you're subject to your cost basis and gain loss. If you're considering staking your crypto coins to earn interest, we talked about that. Interest income is similar to Fiat's taxable. Okay, tax implication, long-term, short-term gains. You talked about that, Pat, right?
Yep.
A little bit. Yeah, long-term, obviously, anything that your holding period greater than 365 days, you're going to have less, your tax rates are less. So make sure that you're utilizing or identifying that, that you're not selling kind of anything that could be coming up on a long-term gain, because you're going to be taxed at a less rate. You'll have a less tax liability. Realized and unrealized gains, you're only taxed on your realized gains. So that's the whole strategy of where I'm talking about sell at year end or tax loss harvesting and all that. You're in these unrealized loss or gain positions. So you want to realize them at the right timing so that you're paying less tax, or not paying the tax until 15 months down the road. We talked about gas fees. Those are netted, included as part of the netted against the proceeds, or they increase your cost basis if they're transfers internally. What else do we have? DeFi questions. Okay. Is taxation from interest received from fiat placed in a bank treated the same as crypto interest received by providing crypto collateral for a fiat loan? So yeah, we talked about interest received is interest income. Again, you have to think of this as all crypto is treated as property. So it's like Apple stock or a house, similar, like anything where you can have like rental property where you can have interest income, right? Just think of it as the same way. So interest income is definitely taxable. How are you supposed to establish a cost basis for interest provided in crypto when you trade or sell that crypto? So it's, again, I talked about cost basis established at the time that you receive when you have dominion or control. Do the things above still apply if the crypto is held in a Roth IRA? Just talked about that at the end. My cloud, oh, here we go. We're seeing all these stories pop up on like Forbes about $200 million being lost. My client lost access to one of her crypto accounts several years ago and has not been able to regain access. Has guidance changed regarding worthless securities? Ooh, good question. Let me get back to you on that one. That's actually a really good question. Crypto historically hasn't counted. Ideas on how to treat this loss. Yeah, I will. Let me do some research on that. I promise to get back to you, whoever asked that. Because I've seen the lost crypto stories and I've thought about that. I just haven't looked up the guidance yet.
You can write it
Unless
off.
you know.
You have to have lost possession of it. If
Okay.
it's Cryptopia, Mt. Gox, you are going to write it off. You'll write it off at market price at time you lost it versus cost basis at time you acquired it. So if you want to claim your Mt. Gox, you don't claim it at 40,000. You claim it at whatever, $100. And then you can't ever like have it come back into your possession, like or you'll have to amend and you'll probably get audited. But you absolutely can claim lost or stolen tokens, ICO scams, rug pull exits,
Okay.
and DeFi, all that stuff. You can claim those.
Yeah, and I remember that from a few years ago. I just wasn't sure if that guidance had changed, which is what she was asking. But yeah, you're obviously on top of that, so that's good. Stacking rewards. I assume that staking rewards happen constantly. Then how do we determine how much we owe in IRS taxes on these staking rewards or loan interest? So yeah, I mean, that's something where, the DeFi protocols, going back to the dominion and control, when you receive that interest, that's something where you just have to determine the exact time of, if it's constant, right? If it's one of those like every second that you're receiving it, um,
use
that gets
software.
fun.
Like you
Yeah,
can't, like,
I was gonna
you know,
say, use
there's no
software,
difference
use that software.
between once a year income and whatever, a 10 million little slices of income. Like you're gonna, like you'll have to report it regardless, and you'll probably need to programmatically report it, and then have like a summary output and then your detailed output in case you need to supply that as well.
What do you do if the exchange you're using doesn't provide a file to download? I'd recommend going to a different exchange. No,
There's very few exchanges that do that. I don't know which
I
ones
was gonna
do.
say I don't have like a million exchanges that I'm testing out constantly, so I'm probably not the exchange guy to ask. If they don't, I would contact them like immediately and be like, I need a transaction history file of some sort, because the developers should be able to pull a CSV file for you. If
Yeah.
they can't, get off that exchange.
And if you're doing a DEX or something, then it's on the blockchain, or your wallet should be able to pull transaction history.
On gifting, if you are married, is the limit higher or double? Yes. So technically, right, it's $15,000 per person. So if you're married, you can give like a joint gift of $30,000. If you gifted more than 15,000, then basically whatever you gift over that is subject to income for that individual that you're gifting it to.
For time zones you report in, usually it's the time zone you reside in. Just kind of keep that consistent. You, as an American, you wouldn't report UTC time zone. You would just report EST or PST or whatever, because you have until midnight your local time to like run to the post office to submit your tax return.
And I say, like, on stuff like that, as Pat was saying, just pick one and then just be consistent with it going forward. So use your time zone, and then just don't like basically stray from that time zone for reporting purposes going forward. I did see a question about FIFO method. Can you change the HIFO? So I have an interesting opinion on this, not tax advice, but in my opinion, every method, LIFO, FIFO, any method that you choose for cost basis determination is, in my opinion, a specific ID method, right? Because you could say, oh, I'm specifically identifying that all first in transactions are first out, or I'm specifically identifying all last in transactions are first out. So in my mind, everything is kind of a form of specific identification. The difference being, with FIFO method, you don't have to keep all of your books and records for specifically identifying which transactions that you sold and that you're saying this is my cost basis. Whereas for HIFO and other specific ID methods, you do have to keep those records. Now, so you're saying, can you switch methods? So that's why I say, in my opinion, everything's a LIFO and FIFO are a derivative of specific ID. Other tax professionals may have a different opinion. This is not tax advice. This is literally just an opinion. So if you say FIFO is just a form of specific identification, then, oh, I just did specific identification on these assets in 2019. Now I'm doing specific identification on these assets in 2020. So if you don't call it FIFO and you just call it specific ID on these transactions, and now I'm identifying these different lots for 2020, there's some gray area where you can, again, if you're documenting all of this and specifically identifying the lots that you're associating with these cells, yes, there's a way that you could probably get around this FIFO to HIFO method. But if you just say, oh, well, this is FIFO and I want to move to HIFO, you can't. You have to pick a method, and then the IRS isn't like that. You have to pick a method and stick with it, or else you're just trying to basically like take advantage for tax purposes. But that's my 2 cents opinion as to maybe how you could potentially make a switch without getting yelled at by the IRS. We're definitely over, but we still have 185 people on. But
I think we'll just be respectful of everyone's time and kind of wrap. We can always hold another webinar. It's January 14th, so we can always help you with all this stuff. Thank you, everyone, for all your great questions. And again, if you want to get a hold of us, here is our contact info. hello@zenledger.io, zenledger.io, and hello@gilded.finance, gilded.finance. Thanks so much. We'll be sending out a recording and a transcript. And thanks so much. Happy New Year. Happy trading. Thanks so much, Joey, for joining.
Thanks, guys.
All right. Bye.
Yeah.